Have you ever wondered what depreciation is and how it affects you? Well, let's demystify this financial jargon together. You see, depreciation is one of those terms that you're likely to encounter quite often, particularly if you've dabbled in the realms of business and finance. But what is it really? In its simplest form, depreciation is the decrease in value of an asset over time. It's like the wear and tear of your favorite pair of shoes, or the aging of a vintage wine. And while it might sound like something that only accountants need to worry about, depreciation has a fascinating way of weaving itself into our everyday lives. It affects everything from the value of the car you drive, to the price of the house you live in, and even the gadgets you use. Intrigued? Well, don't go anywhere. Stay tuned as we dive deeper into the world of depreciation. Depreciation, in simple terms, is a reduction in the value of an asset over time. Now, let's unpack this. Picture yourself buying a shiny new car. It's your dream vehicle. You drive it off the lot and it's all yours. But as soon as you do, it's no longer a new car. It's now a used car and its value has dropped. That drop in value, that's depreciation in action. But why does this happen? Well, it primarily happens due to three factors: wear and tear, age, and obsolescence. As you use your car, it experiences wear and tear. It's not as pristine as it was when you first got it. Age is another factor. As time passes, your car gets older and its value decreases. Lastly, obsolescence plays a role. As newer models with better features come out, your car becomes less desirable and its value dips. Depreciation isn't limited to cars, though. It happens to a variety of assets, including buildings, machinery, and even intangible assets like patents. Over time, these assets lose their value for the same reasons as cars: wear and tear, age, and obsolescence. Think of a building. It's sturdy and new when it's first built. But as years pass, it starts showing signs of age. Maybe it needs a new roof or the plumbing needs to be replaced. And as newer buildings with more modern features come up, it becomes less attractive to potential buyers or renters. That's depreciation occurring right there. Or consider a piece of machinery in a factory. It's efficient and productive when it's new. But as it's used, it experiences wear and tear. Over time, it may become less efficient or even obsolete, as newer, more advanced machinery is developed. That's another example of depreciation. So in essence, depreciation is a natural part of the life cycle of an asset. It's the gradual, inevitable reduction in the value of an asset over time due to factors like wear and tear, age, and obsolescence. So now that we know what depreciation is, let's explore why it happens. There are several factors that cause an asset to depreciate over time. Let's delve into the three main causes: physical deterioration, functional obsolescence, and economic factors. Each of these elements plays a significant role in the depreciation of an asset, be it a car, a building, or a piece of equipment. First up, physical deterioration. This is probably the most straightforward cause of depreciation. It's the wear and tear that naturally occurs as an asset is used. Think of a car, for instance. The more you use it, the more its parts wear out. Its paint might start to chip, its engine may not run as smoothly, and so forth. This physical decline in the car's condition reduces its value over time, leading to depreciation. Next, we have functional obsolescence. This happens when an asset becomes less useful or desirable due to advancements in technology or changes in market preferences. Let's consider a smartphone. Even if you keep it in perfect condition, it will depreciate because newer models with better features and capabilities are constantly being released. Your once cutting-edge phone becomes obsolete in the face of these advancements, and its value depreciates. Lastly, economic factors can also cause depreciation. These are external factors such as changes in the market demand, legal regulations, or economic conditions that may impact an asset's value. For instance, a piece of real estate might depreciate if a new zoning law reduces the demand for properties in that area, or if the overall economy goes into a downturn and people are less willing to buy. It's important to note that these causes often interact with each other. A car may depreciate faster due to both physical deterioration and the release of newer models, and a piece of real estate might depreciate due to both functional obsolescence and economic downturns. With the causes clearly outlined, we need to understand how depreciation impacts us. Depreciation impacts us in more ways than one might think. It's like a silent player in the game of economics, subtly influencing the price tag on your favorite jeans, the return on your investments, and even the health of our overall economy. Let's start with the basics. When we talk about goods and services, depreciation is a key factor in determining their cost. Consider your car, for instance. The moment you drive a brand new car off the lot, it starts to lose value. This is depreciation at work. Over time, as the car ages and accumulates mileage, it devalues, and so does the price someone is willing to pay for it. Now let's shift gears and discuss investments. If you've ever dabbled in the stock market or real estate, you've likely felt the effects of depreciation. Companies that heavily invest in physical assets like machinery or buildings often see these assets depreciate over time. This depreciation can affect the company's net worth and subsequently its stock price. Similarly, in real estate, property values can depreciate due to factors like age, wear and tear, or changes in the neighborhood. But depreciation doesn't just affect individual goods or investments. It also plays a significant role in the broader economy. When businesses calculate their profits for tax purposes, they factor in the depreciation of their assets. This reduces their taxable income, which can lead to lower tax revenues for the government. However, understanding depreciation isn't just about knowing its effects. It's also about leveraging this knowledge to make informed decisions. By understanding how depreciation works, you can better predict future costs, assess the value of potential investments, and make strategic financial decisions. Depreciation isn't all gloom and doom. In fact, there are some benefits to it. But that, dear friends, is a story for another time. For now, let's appreciate depreciation for what it is, a subtle yet powerful force shaping our economic world. Like most things in life, depreciation has its pros and cons. Let's start with the positives, the silver linings that can make depreciation seem like a friend rather than foe. Firstly, depreciation can lead to significant tax deductions for businesses. This is because the cost of acquiring assets isn't fully deducted in the year of purchase. Instead, it's spread out over the asset's useful life. So, if a company buys a machine for $100,000 with a useful life of 10 years, they don't take a financial hit of $100,000 all at once. Instead, they can write off $10,000 each year as a business expense, which can reduce their taxable income. And there's more. Depreciation can also be a tool for prudent financial planning. It allows businesses to prepare for the replacement of assets. Knowing that a piece of equipment will depreciate over time, a company can set aside funds each year to replace it when its useful life is over. But like a coin with two sides, depreciation also has its drawbacks. The most obvious one is the loss in value of assets. As assets age, they wear out, become obsolete, or lose their value for various other reasons. This can be a disadvantage, especially for individuals or businesses that heavily rely on the resale value of their assets. Another downside is the potential for a depreciation trap. This happens when assets depreciate faster than they can be paid off. This can lead to a situation where the asset is worth less than what is owed on it, a predicament nobody wants to be in. Understanding these pros and cons can help individuals and businesses make smarter financial decisions. It's about turning a complex financial concept into a strategic asset, a tool in your financial toolkit. Depreciation, while complex, is a fundamental concept that everyone should understand. So, we've covered quite a lot about depreciation, haven't we? We've journeyed through its definition, understanding it as the gradual decrease in the value of an asset over time. We've explored the various causes of depreciation, from natural wear and tear to obsolescence due to technological advancements. We've also delved into how depreciation directly impacts you, from the value of the car you drive to the cost of the house you live in. And of course, we've weighed the pros and cons of depreciation, acknowledging that while it can be a disadvantage for those looking to resell assets, it can also provide significant tax benefits for businesses. It's important to remember that depreciation is a fundamental concept in finance, and understanding it can greatly influence your financial decisions. Knowledge is power, after all. Remember, understanding depreciation can be your key to making more informed financial decisions. Thanks for watching.